This video is brought to you by Lemonade. Sign up for homeowners insurance, renters insurance, life insurance, and pet insurance at metkevin.com/lemonade. Go to metkevin.com/lemonade and check out the offerings that Lemonade has for you. Super quick and easy to sign up for. Hey everyone, Kevin here. So we're all looking for catalysts to try to understand what the heck is happening in this marketplace. And we finally have a little bit of a longer run guidance from the Fed. We just got a little bit more insight, and I love getting this information, even though it's coming out like a slow trickle. It's good to know what kind of parameters the Fed is looking at to know when are we actually going to be at full vaccination to the point where they believe, okay, the economy has now cleared the COVID risk. Let's now move from COVID risk into full reopening and moderating inflation. Well, folks, we kind of got an answer right here. Let's listen to this. This is the actual clip where we hear about it, and then we'll analyze. Let's go.
Yeah, I think for right now, even though we're all very hopeful that the pandemic will come to a close in the U.S., we're not there yet. We're still vaccinating. We're still rolling out. We're still watching for other developments on the virus. So we're not to the end of the road here, and I think it's too early to talk about changing monetary policy. We want to stay with our very easy monetary policy while we're still in the pandemic tunnel. If we get to the end of the tunnel, then I think it'll be time to start assessing where we want to go next.
How do you define the end of the tunnel? I mean, we have been.
I mean, in terms of the pandemic
sure,
itself.
But I mean, in particular,
you start to get to 75% vaccinated, 80% vaccinated, and CDC starts to give more hopeful messages about that we're bringing this under better control, and starts relaxing some of their guidelines. Then I think the whole economy will gain confidence from that. And we'll see if we get to that point. It looks good right now, and the data looks good. Cases are up some.
All right, so let's pause there. That's actually a real clear signal for us in terms of, okay, when are we going to start that bond tapering discussion? So quick outline of a schedule. Remember, I've mentioned on this channel before that I believe rate increases will come about 18 months after the Fed begins to taper their bond purchases. Right now, they have emergency levels of bond purchases going on. You've got $80 billion per month of treasury bonds and $40 billion of mortgage-backed securities being bought every single month by the Fed just to inject cash in the economy. And the more the Fed buys these bonds, the more prices go up and the more yields go down because you have more demand for those bonds, and then yields go down, so rates go down. So the Fed is really keeping rates down in two ways. One, with, well, the federal funds rate, but then the other is also their bond purchasing. And this is why we're all paying attention to that tapering. When are they going to stop doing this bond purchasing? Because when they stop, then you have less demand for the bonds and the yields could go up. When yields go up, then market rates push up, whether or not the federal funds rate has been changed or not. So here's the thing. If we do some really quick generic math here, we see that right now we are at 22% vaccinated per Bloomberg's vaccine tracker. We are trying to get to 75 to 80% per Jim Bullard of the St. Louis Federal Reserve, the president there, to actually start having the conversation about tapering bonds. Well, at this rate, we are vaccinating approximately 3 million individuals per day. So if we take about 30 million individuals in the country, and we multiply that by 22%, we get to around 72.6 million people fully vaccinated. We're trying to get to at least 75%, to 47.5 million. That means we've got 247.5 minus 72.6. We have 0.9 million people to go with vaccinations, which we expect, we talked about this on the live stream earlier as well, we expect that this 174.9 to be able to be complete sometime, given that you have to give people 2 doses, so you got 2 doses. If we're doing 3 million vaccines a day, you got to multiply the number by 2, essentially. So if we do 3 million a day, we should be able to achieve that target within 4 months. So 4 months, or if we do 4 million vaccines a day, 3 months. So in 3 to 4 months, we can actually hit this target that he's talking about of 75% of individuals vaccinated. Add about a month for people to actually get fully vaccinated, because the last people to get the dose is still going to take about a month. So we're talking really between 4 to 5 months. So if we jump on over here and we go 4 to 5 months out, take a peek at this. So this is my projection for how interest rates might move. So we're here. If we go 1, 2, 3, 4, 5, we're somewhere over here between August and September where the Fed starts talking about tapering. The interesting thing is at the same time, the Fed will also, at least in the projections of the Fed, be able to see, okay, how much did inflation come down naturally? Did we end up balancing around 3%? Did we end up balancing around 4%? Did we balance around 1.8%? That's going to help the Fed determine, okay, do we need to taper now or later? Or do we need to raise rates now or later? So my expectation was we'll be somewhere around this mid 2.5% range here. If we go lower, then there's less need to taper. But around that same time, if we continue with these vaccination rates, we should be fully vaccinated, or at least 75 to 80% vaccinated. 80% would push us more closer to like September, October. So what we're really talking about is September to October being a big moment for the future of the economy. Will the Fed tighten right away because they've lost control of inflation, or did inflation come back down, everything kind of go back to normal, Fed goes, hey, look, the economy's booming, we don't really need these bond purchases anymore, let's go ahead and start reducing the bond purchases in November, December, and then that sends the signal that they'll probably end up raising rates sometime at the end of 2022, beginning of 2023, which is a long expectation. Anyway, remember this, sometimes I say 18 months, sometimes we think it's 12 months. Between 12 to 18 months after a taper is really when we expect to see rates go up. So that could be the end of 2022 all the way through about the middle of 2023. So far, this is another hint that reiterates that right now, the Fed is literally just gonna blow smoke. And I know that sounds negative, but they're basically gonna say whatever they need to say between now until we get to this lower point over here, if we get to it. So we're really got to get through this hump over here of inflation data. And obviously the next big piece of inflation news comes out tomorrow morning at 5:30 a.m. Pacific time. I will be live streaming it, so stay tuned for that. But yes, that hump is the big deal right now. But hey, it's always good and insightful to understand, okay, all right, so that's a metric the Fed is using. It's the first time we've actually heard the Fed suggest an actual metric for when tapering might be a consideration. So this is pretty interesting news. Now, the St. Louis president also indicated that he sort of reiterated this right here, doesn't believe that there's going to be an inflationary risk towards the end of the year, but we'll have to see. Again, that kind of reiterates what we have here, and also touched on some other things that were, in my opinion, a little less important. We did have Fed Chair Jerome Powell on 60 Minutes yesterday give us a lot of his insights, which I covered as well. But this new little bomb drop here, also really good to pay attention to, so throw that on your calendar. Thanks so much for watching, folks. If you found this helpful, consider subscribing, get your insurance with Lemonade, and folks, we'll see you in the next video.